Can I get a loan to buy a business in New Zealand? A very, very common question that pops up, and the answer from the top is yes, but there's a lot more to it than just the YES, isn't there, Phil?
100%, mate, and it's fascinating the amount of people that are looking at buying a business and haven't thought about how they're actually going to pay for it.
Yeah, blows my mind.
Yeah, and I was just thinking about it before we hit record, and it's just like, well, you've got an aspiration of going out and buying a Ferrari. You're not just going to go up and go and test drive one without knowing, can I actually afford this?
They're probably not even going to let you drive it.
Probably not.
Yeah.
But the amount of people that get the information memorandums, the IMs, from brokers, and then go, oh, this one, oh, I'm really excited about this. The emotion starts kicking in, and then you start having all these ideas in your head about what life will look like and what you could potentially do with this thing, and you haven't paused and gone, okay, they're asking 500,000, 800,000, $1 million, whatever the number is for the business, and gone, that's actually some money I'm going to need to hand over. Where's that coming from? Because we ain't got no money tree out the back. But more often than not, yes, you can get a loan to buy the business, and banks will do it. And you can get, more often than not, the ones that we see are going to be secured against a family home. So somebody that's bought a house many years ago, paid the mortgage down. The New Zealand property economy, the backbone of New Zealand, has just doubled in price over the last however long, so your house is now worth an astronomical amount. So there's all this equity on paper. Well, the bank will let you lend against that to then release some cash to go and buy the business. Now, the important thing to realise about buying a business is that the ratios are different to buying a house with debt and equity. So when it's your own home, you might be able to do 10% deposit, and the bank will lend you 90% because they believe in housing. Unfortunately, with a business, it's a bit too much risk for the banks. And they're like, we're not so certain about business to be generating income because it's not property. So we might only lend you 50%, 60%. Then we've got to unpack it a little bit more and go, well, are there assets that we're securing against? If there's no real assets and it's a big goodwill purchase, then we're lending on the ability of the business to generate cash flow into the future. How certain is that? What are the risks? I mean, we just open a whole massive big can of worms. I could talk about it for ages.
Yeah, I'll just pause you there because people won't understand. So when you talk about like goodwill versus assets, you're talking about assets in the business, right? So assets. I'm going to go buy a civil engineering company, and it's got $3 million, well, let's say $300,000 worth of kit, and I can borrow
They're going to have diggers and trucks and compactors and the goodwill, a Ranger.
And a Ranger, of course. And the goodwill that I'm paying for would be, I've got certainty of income in the future because I've got this big contract to the government, for instance, and so I know that income is going to come in, I'm going to be able to pay for those, and then I've got this sort of skill set that I bring to it, and we're going to open up this market over here. So that's a difference between assets and goodwill, and those come together to give you your overall selling price that I've got to pay.
Yeah, and that's a business, I suppose, that's using assets to generate income. The other example could be, say, a graphic design agency, where it might be a person with a small team, and they've gone out and done some marketing, got some great customers, and they're selling their services. There's no fixed assets beyond maybe a few computers and some Adobe software. Like, there's nothing of substance that the bank can then come along and go, well, if all this tips over, we can grab those assets and sell it. So that's a highly leveraged towards goodwill on a purchase like that. So the bank's going to see it as being more risky and therefore potentially harder to lend against. But everything becomes easy when we've got a house with equity, Luke.
Because the bank will give us the money to buy that business, to buy that design company, because they don't really care if Next Advisory says to the design company, like, oh, I didn't realise you were changing owners. We don't want you to do our work anymore. Bang, there's $60,000 worth of work they don't do anymore. The bank are like, well, we can always sell your house up to get our cash back.
It's amazing when you're talking to a business owner going through the due diligence, and this has come up in the last few weeks on a couple of transactions that we're helping people with. There's one instance where a client is just so emotionally invested and excited about the prospect of ditching their job and owning a business, and it's going to be fulfilling for them because it's something that they're interested in doing, and you can tell that they've got quite romantically attached to the idea about it. And I have to say, hey guys, just slow down here, pause, breathe. Yes, you're getting pressure and deadlines from brokers and bankers and all of this stuff. And the classic line I said, your house is on the line at the end of the day. And they're like, oh, wow, that's a really good reminder. Let's actually just pause, take a moment to look at the numbers, understand it, and go, does this stack up transactionally and objectively, not emotionally? And then it was the same in another one a few weeks back. And in this particular one, went through full due diligence and opened up a can of worms. And in this case, they were using equity in the family home to buy this business. And on the surface, it looked like an absolutely fantastic business. And the purchaser was really attached to it. Go, we can do this, we can do that, we can go and find this opportunity, and they're only exposed to this much of the market with this product, and we know that there's opportunity here, and da-da-da-da-da. And then when we did the due diligence report and crunched some numbers and gave them some data and did some what-if kind of planning to go, hey, look, these are the risks associated with it, and then tuck in the line of going, remember your house is on the line. Whoa, whoa, whoa. And then they backed out, and that's cool. You know, it was quite impressed that they were able to detach the emotion and go, no, we've got more emotion attached to the family home than we do to the business. But coming back to the question, yes, you can get a bank loan for the purchase of a business, and it is a lot easier if you have a family home. If you don't have a family home, can you still buy a business? Absolutely. It's going to be harder, but you're going to be looking for a much better quality business that's got certainty of cash flow, because the bank's going to be doing what is called a cash flow lend, or there might be assets in there that the bank can lend against, but there's no other personal assets that you have got that they can take a chunk or a bite out of if it was to all fall over. So that's where you're probably going to need to have some cash of your own to be able to tip in. So if you're buying a business of, say, $1 million, just to keep the math simple for my little brain, you know, you're going to want a few $100,000 to tip into the business purchase, plus extra cash to pay for the advisor fees. You're going to need a lawyer, you're going to need an accountant, there's going to be all the other costs that you're going to need to come up with before you actually settle. Then you're going to need a pot of cash for working capital come day one when it actually settles, because you're going to have wages, rent, stock, bills to pay before you actually sell something and collect the cash.
So just before we carry on with that, so you say buy $1 million business. My small brain's like, but you said I only need 300 grand. Like, where's the 700 grand coming from? What do you mean? Do I need 300 grand of physical cash, or how am I going to pay for the whole million?
Yeah. So you'd in this particular case, if you didn't have a house and you found a really good business and it's $1 million, you could go to the bank and go, hey, look, I've got $300,000 in cash.
Yeah.
And they'll go, we'll give you the 700. Because it looks like a good business, you've got the right skills, you've got a really sound business plan, and you've done a forecast which demonstrates what this business is going to look like into the future. It's given lots of green ticks and given the bank confidence that you know what you're up to. In addition to the $300,000 of your own cash that you're tipping in, you're going to need more than that, because you need to pay for the lawyers, the accountants, and then by the time you've actually purchased the business, the wages, the stock, and all the other bits and pieces in the first month or two before your customers actually ultimately pay you. So it might actually be the $300,000 that you originally had turns into $400,000.
Yeah.
And if you're chewing up $100,000 of your own cash in working capital and pre-purchase costs, the amount you've actually only got to contribute to the purchase is $200,000. So then that could completely reframe the type of business that you need to be looking at. So instead of $1 million, you might need to be coming back to $700,000 or $800,000 and then chipping in $200,000 into that.
So I come back from Vegas and I've got 300 grand cash because I've just absolutely taken to the cleaners, said no one ever. But I decide to buy this $1 million business and they lend me 700K.
Foolish.
Yeah. And I buy this business and I go, righto, like we're rolling here. Luckily, I've got some access to some other cash as well. I bet they're not going to give me 30 years to pay back my 700 grand, are they?
Spot on, mate. That's a really good point. Is business debt has got a shorter repayment window than a house. Because
they want their cash back because they hate risk.
I mean, does the house always win? I mean, are these guys casinos? Are they a Ponzi? Like, what's going on here? But you're spot on. I mean, with a house, we can have 20, 25, 30 years on the initial loan term, and then holy, we can move banks and then refinance and reset the clock and go again for another 30 years, even though we're 5 years deep into our original term. But with a business, in our experience, the loan repayment period, the maximum that I think we've seen is out to about 10 years. Typically somewhere in that 5 to 7 window is pretty standard. And what that will mean is, using the numbers that we had before of $1 million business, $700,000 of debt, that $700,000 of debt, if you were buying a house, you'd pay it off over 30 years. The repayments would be $600 a month, maybe, I don't know, $1,000. I don't know what the maths are.
Yeah.
But when it's a business purchase, we've got 10 years to pay off $700,000. So we're paying $100,000 a year off the principal.
70,000.
70,000, sorry, a year off the principal, and we still need to find money for the interest.
Yeah.
So you can see that if you're getting debt and it's over a shorter window, the cash flow impact is huge. So a lot of people, when they look at an information memorandum for a business and go, my current salary is $180,000, this business owner is taking $200 and something thousand, I can jump in there and make 200 and squeeze the profit. What you're not recognizing, or is easy to overlook, is going, well, that business owner's got a profit after funding their balance sheet. You need to take their numbers and go, what is my position going to look like, aka the debt, and what's going to be the impact of the interest and the principal repayments on the overall cash flow of the business, and is it sustainable?
And the tax, right? Because to clear 70 grand worth of debt, you've got to do that with after tax profit.
Yep.
So you've got to get your profit, put the tax aside, and then go, right now I've got my after tax amount that's mine. Well, I've got to give it to the bank to
Is
pay
it 100
back.
G's,
Yeah.
30 grand of tax?
Yeah, so going to save you from your 100 grand before per year, you basically need to make 100 grand
Yeah.
of profit,
Yeah.
30 grand aside for tax, very high level numbers, and then bang 70 grand to the bank. So you make 100 grand profit, 30 to the IRD, 70 to the bank, and then you do it again for 10 years. So I think some people can get into buying a business, and then within those first couple of years, they're like, shit, like I haven't made any progress. Like, where's the cash? We thought it was going to be different. But remember, you're buying an asset and you're building up your balance sheet, and you're building up equity in that business and your personal balance sheet, and you're doing it a lot faster than what they make you do it in property.
Yeah, and it's a downside more rewarding and fulfilling, I reckon. Yeah, cop that.
We might be
property
biased.
investors.
Yeah. Hey, you go.
Oh, I was going to say the other one would be vendor finance, and it doesn't happen a lot, but I think it's becoming a little bit more of a discussion point in the businesses that we're looking at, particularly where there's younger business owners coming through going, we're hungry, we want more, we don't believe in property, that's what the boomers have done, they've fucked us, let's do something different, we're looking to business. And the amount of younger people that we're talking to that are looking at buying businesses is exciting. And the unfortunate thing with younger people is they're not as cashed up as the boomers.
Yeah.
Sucks. I mean, because they've just made their money through property.
Because
But
then
anyway.
the young people have had to pay 10 times the amount for these same properties to try and get on the old ladder. Yeah. Anyway.
Anyway, we could go on for a
Yeah.
while. But the other way is going, well, I do have some cash. The bank is prepared to lend me some. Let's say of the example that we're using before, $1 million purchase price. We've still got a couple of $100,000. We need to find $800,000. The bank is going to lend you $400,000. There's a $400,000 gap. You might find that a motivated vendor or seller of a business, a boomer, because there's lots of them. We did a podcast recently. 1 and 2 businesses that are going to come to the market are owned by boomers, and they're going to need to sell, and they don't have a plan. So there's huge opportunity there. And you might go, well, you leave $400,000 in this transaction as a loan, and we'll set it up. We'll pay you principal. We'll pay you interest. Over a specified period of time. And in addition to that, you might have some KPIs or some performance metrics attached to that loan to go, well, because these boomer businesses have just relied on so much goodwill and they've got really sloppy systems, and there's increased risk on some of these things, you can go, well, to mitigate this risk, we'll make you leave some money behind so that you're incentivized to make sure that the business remains sustainable into the future, because you're going to want to get repaid. And if any of these key things change, so we identify through due diligence that, yeah, revenue's really good, but the majority of it is attracted to 5 key customers. If one of those key customers drops off in the next 3 years, we could go back to the drawing board and actually go, no, that then results in a discount or reduction in the purchase price, which is ultimately going to come off the loan. So the vendor's going to be motivated or incentivized to make sure that the transition from the old guard, them, to the young buck purchaser, the new person, to go, yep, let's hand over the relationships. Let's make it all seamless because I've still got some skin in the game, and 400 grand for a boomer, that's going to be their cruises for the next 10 years maybe.
Yeah, you mean, cruises. Sorry, I thought you meant vodka cruises. Sorry, you mean going on a cruise.
Going on a cruise.
Yeah, of course. Hey, why I think as well, it's not just, people might go, well, I'm not thinking about buying a business, but maybe you're not right now, but a current business owner may end up being tempted too, because we're seeing more and more where these baby boomer business owners, as an example, are going, you know what, like I'm done, and they're shoulder tapping a younger business saying, hey, I've got a $400,000 business here. Do you want to bolt it on to your electrician Sparky business, to your construction business, to your plumbing business, to your engineering business? And you go, oh, shit, I hadn't even thought about that. But this is why it's really smart to have good personal finance hygiene, throughout those years, to give yourself options so that you go, oh shit, well, thank God that we've got all this equity in our property because we've been diligently paying down our mortgage and paying it faster than we need to. We're in the position to buy that business, and somebody else might not be. Or you need to understand vendor finance and learn more about it so that when these things come up, it's not like, oh, that sounds too risky, I'm not sure about that. And you're already a bit closer to making sense of it or understanding it all, rather than just like, no. But I guess the danger there is that often too, we see people go, oh, I've been approached to buy a business. Do you think I should do it? Oh, I've done it. And you're like, mate, what's the plan? Have you been thinking about this? Oh, what do you mean? Like, well, why all of a sudden are you thinking about buying this business? Just because Sally tapped you on the shoulder and said, we're going to sell. Sally the seller doesn't mean that you need to be buying their business.
Yeah, spot on. And it can be really exciting. And if you are exploring the idea about buying the business, I would encourage you to educate yourself on the process and the steps that are involved, and then start looking at the IMs and going, okay, what is actually out there? And going, if I'm looking at this particular business and comparing it to these other ones, how do they stack up? And then going, right, I've got something that I'm interested in now, let's start the discussion and put it in front of my banker and go, hey, I've found this and I'm interested in it. I've been looking for the last 6 months and this one is actually starting to tick some boxes for this, and this reason. Is this something that you think the bank would support me in, or am I just wasting my time? Because so often people get so far ahead of themselves that then they go and ask that critical question and then they get a no.
Yeah.
And it's just like, well, okay, let's go back to the drawing board and go, well, how can we turn that no into a yes? What are the things that we need to do to get ourselves into a position? And that's where a banker and a good accountant will be able to give you the advice to go, these are the things that you need to tick off and get yourself ready and be in a position to be, when the booming business does come to the market, of going, boom, I'll take that one because I've been doing my homework. It's like saving for a deposit for a house. We don't all of a sudden wake up tomorrow when you're 27 years old with poor saving habits and a really poor track record at the TAB and go, I'm going to buy a house. Most people are going, right, I've committed to KiwiSaver. Instead of 3%, I've done 6%. In addition to my KiwiSaver, I've been diligently managing my costs, putting cash away, and might be you and a partner and you've got a combined account. You're doing all the things and you've got the habits that are aligned to what that outcome is. Buying a business is no different. You've got to be putting in place the habits and the bits and pieces to put you in a position to be able to execute it, because at the end of the day, we're buying an asset, and it's an asset that generates income, unlike a house, which is just sitting there for you to live in and give you a lifestyle. A business is so much more exciting because it's got that income generating aspect to it.
And one thing you touched on before was interest. Now, people need to remember that borrowing money to buy into a business, the interest cost is tax deductible.
Yep.
So that means even if I'm borrowing money to buy shares, there's a high chance that I can claim the interest cost on buying those shares. Now, that might be to the stock market, or it might even be just shares into an engineering business or something. And you're probably, going back to some principles, going to get a cheaper rate if you can borrow against property. But, let's say Luke doesn't have property. He's got, let's say, $500,000, and I want to buy into a business and go, maybe I'll take a stake in that business, and I could put my capital in, or I could go to the bank and say, hey, actually, I want to buy into that business. Will you lend me the money? Here's the security and the things that I do have. And they go, yeah, well, actually, we will lend you the money to buy into that. That's fine. Now, my interest on that debt is tax deductible, buying into that business. So, again, there are new rules over in this space, so you want to understand it.
How's your interest bill on those Heartland shares, mate?
Oh, jeez. I've been skinned. I've got to repay the debt back. I've got to pay the debt back. The cost of interest is disgusting, and the share price continues to drop.
I couldn't help but a cheeky poke at
It's only fair.
at Heartland. But the other thing about buying a business, and you're alluding to it a little bit there, was where an employee is working in a business and the employer is now tapping them on the shoulder and saying, hey, look, would you be interested? We're exploring. Do you want to take on 10%, 15%, 20%? What does it look like? Ultimately, as an employee, you're going to need to buy those shares because the boomer vendor wants to get paid. It's not like we're giving you something. We're not going for handouts here. It's you're buying an asset which is going to generate an income. And in the case of a minority shareholder where you're buying into the business that you're working in, you're going to collect a dividend.
Yeah.
And there's a number of ways that can be structured. And we've helped a number of clients with that. I'm surprised how many in this first quarter of the year. And some of them are going to be supported by their employer, where the employer will loan them the money. And if it's a really great employer, it might be interest-free. Some of them, it might be a loan and there is interest charged. The interest, to what you were talking about earlier, that's tax deductible for you as the shareholder employee. What you'll ultimately find is that loan that the company has given you to buy the shares, the dividends that you're going to get as the income, so that's the distribution of the profit that the company's made that you're allowed to have a bite of the cherry on. So if the company's got that $100,000 profit, you've got a 10% shareholding, there's a $10,000 dividend. Instead of receiving that, that's going to go back to repaying your loan. That's pretty standard in this type of thing. In another example, you could actually instead go to your bank and say, hey, look, I've got the opportunity to buy 10% of this business, $1 million business, I need $100,000. And the bank will go through the same process as if you were buying a business ordinarily. They might do it a little bit differently, but go, hey, look, are you in a position to be able to borrow the money and repay? Yep, here's the $100,000. You give it to the boomer shareholder. They give you the 10% of shares. Happy days, away you go. That interest on the bank loan is tax deductible in your tax return.
Well, the answer, like we said at the start, is yes. But of course, there is a lot more to it.
A lot of hooks.
Yeah. With whatever business you're thinking about buying, whether it's into a business, whether it's your competitors, whether it's buying a business from scratch and you're not in the arena at the moment, it's okay. But put your hand up and ask for some help. There's a Calendly link to book a time to Phil on the website if you want to discuss something specific or get some consulting help. This is going to be a huge space as these baby boom businesses come to the market, as young people build up equity, as they choose business over rental properties. But you need to give yourself the baseline understanding and do your degree and do your education before really diving into the deep end. Otherwise, it is all going to be a big fright. And that's the beautiful thing in this day and age is you can educate yourself. Just like me and Phil going to uni, we would have to learn about accounting and then get tested on it before then getting a job and getting into the market. You can learn about anything these days and then go, you know what, I think I really do want to do that. But Phil had that really good question earlier. Are you willing to take the risk? Are you going to put your house on the line? Are you going to put all that capital on the line? I think it's very easy to do something when we don't have true skin in the game. Yeah. Where it's like, okay, it's 100% finance. We don't really feel like we've put anything into it. And lenders will tell you that those are risky people as well because they know that that's psychologically like how they operate. But as soon as you've got to risk the home that you've built up or the funds that you've worked hard to put aside, you're going to want to make sure that you don't lose those because not many people like going backwards.
It's an absolutely exciting game to be in, and I think if you're interested in buying a business, there are ways to cut a deal. Like you say, go out, educate yourself, and get hungry and get after it.